Andreas, Niki and Daniela for those opening words. And with that, it is now time for our first keynote of the day. I'm delighted to announce that Monika Köppl-Turyna is with us here today. She's a professor of economics and entrepreneurship and director of the institute EcoAustria. And it's no exaggeration to say that she's one of Austria's most prominent economics. She's going to be talking to us about the key findings and about the concrete implementation steps of EcoAustria's study on the Austrian Scale-Up Fund, the Fund of Funds that's also been mentioned already in the opening words, and she'll outline how the results can guide the government's current efforts to establish and execute this new growth instrument. Please welcome her with a round of applause. Thank you.
Good morning. Thank you for having me. As was mentioned, I'm just going to talk a little bit about the study we conducted on how to implement the Fund of Funds in Austria and why is it important, and also what not to do, which will be a relevant part of my presentation in order for the model to be successful. Okay, so the title being, excuse me, a Fund of Funds as a strategic tool for Austria's economic transformation. So let me start with why this is important. What kind of economic transformation do we need? What Austria has been known for in the recent decades is a very, very strong industrial sector. So many people from abroad think that we're the tourism country, but that's certainly not true. A much bigger part of value added in the GDP comes from the industrial sector. However, as you can see in the figure, starting around 2022, 2023, in particular during the Russian attack on Ukraine, which raised the energy prices, the industrial sector in Austria has been struggling. It was maybe struggling a little bit less than the German sector, but that's not really good news because we actually export a lot to Germany. So if there is no demand from Germany, that's bad news for Austria. And you can see this has been true for many European countries. So the problem being is that while we will certainly not be able to keep the industrial structure in such a way which was possible to be done before, and what is missing is really new kind of models, in particular in high technology, which are not following what will be certainly somehow lost as a part of the Austrian and European economy compared to the past. So in particular when it comes to high-tech industry, I think it's clear that new business models in high-tech industry require different kinds of financing. So traditionally European economy was very financed mostly by banks, which worked pretty well as long as you had a lot of tangible assets which you could put in as collaterals and have them being financed. But increasing regulatory burden and increasing in importance of intangible assets and know-how in the industrial sector, but obviously also in services, has led to a necessity to have a different type of financing of the economy. The transition to modern industry, in particular catching up with technology firms from America, need a lot of equity to be able to scale up businesses and scale up models which exist in Europe and in particular in Austria. Okay, so what is the problem? So when we look at the European VC market, and this table shows you total VC, so including early stage, but in particular late stage, so Series A and beyond, you can see that the amount of venture capital and later stage rounds for growth capital are really, really very low in most European countries. So when we compare, Israel is a very special case, but even excluding Israel, when we see most European countries are quite low in terms of GDP. In Austria, we have about 0.02% of GDP is included in venture capital and in growth financing. At the late stage, the number is even lower, and that's where the Fund of Funds comes in. So generally, there is not enough financing in equity for high-risk technology projects, but the gap is particularly pronounced when it comes to later stage rounds. So this is why we need to sum up a high sums of equity financing, in particular for later stage throughout Europe, and in Austria you can see even more so. The one thing which is also a bit of a feature of the Austrian venture capital financing is that there's actually a lot of public money involved, in particular in very early stages. So we are capable to finance very early seed and early stage rounds with a lot of public money, either through public VC funds or through subsidies. But then we also know from the literature that public money directly invested is usually not very efficient. But what is certainly missing is the follow on, right? So the moment the business wants to scale and want to go across the border. The other feature of the Austrian market is that there is actually a lot of private money in Europe. And yet again, this private money is certainly not used very efficiently. In the sense of there is private money in endowments, there is private money in pension funds, there is private money in banks, there is private money on saving accounts, but there is no, at least in Austria, we don't have a vehicle to mobilize this private money in order to support the tech sector. So this is what we really want to achieve with the funds, the fund of funds model. So as mentioning, I guess the fund of funds will be a lot of talk about fund of funds today. So what we proposed, and we conducted a study jointly with lawyers from Helsinki who are dealing with the legal part, we're the economists. We proposed a particular model on how the fund of funds in Austria should be implemented based on best practice from all over Europe. We talked a lot to Capital, but we also talked to other people. We did a lot of academic research, and we're trying to figure out what is the best way to implement it so that the whole model will really fulfill the goal we set for it. Where are the financing gaps? What kind of strategy it should follow? How should the governments look like so that we will not run into problems and that we will minimize the risk and really make it something which works pretty well. So the first thing, we really want a fund of funds which focuses on later stage financing. So you can see from the data is that it is not the case that the early stage is very, very strong, but at least it's stronger than the later stage. So what we propose is that most of those investments should be going to Series A and beyond. However, we also want to open the possibilities to strengthen the Austrian ecosystem and provide for more competition in early stage funds. So in the study we described this very precisely, that at least part of the sums could also go into early stage rounds as anchor investments to promote establishing new funds. What is very, very important for us is that this fund is not supposed to only invest in Austria. So we don't want the Austria-only solution. Why is that? Because we know from research that if we force a particular focus on a very small, well, fairly small market, then it comes at a trade-off, it comes at a cost of probably not being able to achieve the highest possible performance. And if you really want to attract private investors into the fund of funds, then you have to promise them high performance. So focusing on narrow industries or narrow regions is not the best idea. It should be profit-oriented, so it should not be a political vehicle. It should be a privately organized, profit-oriented funds, which will, because of the need to perform well and to be managed well, will gather private money, and the funds in which it invests must meet the highest standards which we know from the private market. And as I was mentioning, while the focus should lie on later stage investments, the scale-up financing, as was mentioned already, but at least part of the money, we think that there is not enough competition of early stage funds in Austria either. So providing for more competition in the market by maybe anchoring some other funding of new funds is also a good idea. So more competition, more better. So that's on the very general level, and now we get a little bit more technical on how we really think this should be done. So these next two slides come from the study, which you can see, and you can download it from our website or the website of the Ministry of the Economy. It's in German, but I guess some things are clear, a lot of English words there anyway. So we did look at the all the things which need to be taken into account, right? So I guess most of you know what a fund of funds is. So just on the left-hand side, that's the general structure of a fund of fund. And what we say is that the state, the public money, essentially should be just one of the LPs, right? So it should not have any more control, maybe even less rights than the private money in order to attract them, but certainly not more. So that's the structure. While the general partner, the actual fund of funds, is organized as a privately governed institution. So the recommendation we gave to the ministry is an independent structure with a supervisory board, maybe an investment committee. Obviously, the state can be a part of the investment committee, but it should not have more rights than anybody else. It should be return-oriented. It should be purely performance-oriented. The legal form, I'm going to skip that because I'm not the lawyer in the study, but we also dealt with all the things which should be considered for in order to make it a legal object under the Austrian law. So I will get to the more economic part of the story. So as for the investors, which we think should be the target investors of the fund of funds would be large institutional investors, those who will be providing large tickets, pension funds, insurance companies. We have also a dedicated part of the study into looking into the regulation, whether there are certain regulatory hurdles which will prevent those players from investing in the fund of funds. We didn't find many, but there are certain issues which obviously need to be taken into account. The state, as far as the state is concerned, we have actually discussed several models in the paper. So our preferred solution would be just the state as a regular LP, but there are other options. So other countries did it in different way. In Denmark, different models were tested. In Germany, different models were tested. So one of those things should be implemented, but I think the best solution would be just to have an anchor investment from the state and then just a regular LP. What is really, really important is the management team, right? So it will only work if we are able to have certainly an independent, internationally recruited, experienced team, which is completely free from any political pressure. So that's what we mentioned about 25 times in the study, is that that's one of the key factors which need to be taken into account. So we don't want to have there somebody sitting which does not have experience, because that will not attract investment from the private sector. As come from the remuneration, I'm going, this is a fairly standard case. We discussed a lot of possibilities, but essentially it should be organized as any kind of a private fund of funds with the typical elements of remuneration which align the incentives of the management with the incentives of the investors, such as carries, such as management hurdle rates, callback clauses. I'm going to skip. One important part here is that obviously with any kind of fund structure, we have a problem of a double carry. So we thought that maybe even more to attract private money, we could have the state have a lower management fee or a lower carry, or the management fee could be lower than in direct funds because of the big pool of money, you can actually have a lower management fee in percentage terms, which still will equate to a highly competitive salary for the management, and it will make it more attractive. So we have also discussed this part in the study, how to make it more attractive from the remuneration perspective. Investment focus is said, again, something which we have stressed many, many times is no Austria-only solution. Why is that? Because obviously politics want to see success in their own country. Well, that's obvious, but you should not force anybody to do it, because it will not provide the best performance. On the other hand, what we know from academic literature, that there is always an investor home bias. So we can always expect the home bias to be around 60–70% when you look at the European data, and later stage rounds maybe a little bit lower at 40–50%, but that's still enough investment in your own country. But it gives you a correct incentive to be performance oriented and not to try to find targets which are in your own country. So it should be able to invest Europe-wide. It should not be doing pure buyouts. It should be only involved in minority stakes. Skip this part for time reasons. Why is that? But that's essentially the best practice we should think. So essentially what we really don't want is a buyout fund, because that's, in our opinions, politically a little bit too risky. As I was mentioning the role of the state, so our preferred solution would be an equity investment as a signaling effect to anchor more investments, but we also discussed two other models which have been used in other countries, such as partial loss guarantees or favorable loans. Favorable loans it's a bit tricky. The idea here is to have a loan from the state to the private investors, which will risk lower the risk for the private investors, it has to do with the fact that certain institutional investors have regulations involving not being able to take too much risk, but that's something which is really difficult to implement it, so we don't think that's the best solution. As for the investment focus, we dedicated part of the study to analyzing what kind of financing gaps there are in the Austrian VC. So we looked at data from deals from VC funds, in what kind of companies they invest, what kind of investment focus they have, and we were able to identify several niches which are promising, on the one hand from strategic perspective as very well fitting to the problem of industrial transformation in Austria, and on the other hand, these are the ones in which the gaps are most prominent, and we said clean tech, industry, location relevant innovations. So along those lines, maybe a little bit life science and healthcare, but part of that should be also open financing, not to make it too restrictive and really give the management the possibility to work efficiently. What we also did is we worked with actual numbers and thought what could be a size which would be an important size and then the relevant size to also make the Austrian VC scene at a relevant player at the European market. So we think of a volume of between 300 and 500 million euro with an anchor investment from the States. You can see we assume that 1/5 of this capital should come from the state, so between 60 and 100 million, and it would leverage 1 to 4, which is a very conservative assessment, in fact, because there are a lot of studies who tells you that the leverage could be even higher, but we didn't want to promise, too much. So we really took the conservative estimates from the literature and saying, realistically, we're talking about the leverage of about 1 to 4. So with 60 million of public money, we could be able to leverage 300 million. In total. What would that bring? So my colleagues were running our economic models and figuring out how much of an impact it could have. Well, it turns out that really even in the short run, this is a win-win situation, because the firms you are able to support are much more productive. So even if you don't let them invest only in Austria, a lot will be invested in Austria, and a lot of tax money will be coming back here, and obviously also tax money from the investment themselves. So for the more conservative scenario of a 300 million fund, we talk about value added of about 200 million euro in the short term, at about 600 in long term, meaning that there is the multiplier of about 1 to 10 of the public money in the longer term. I'll get to the longer term in a second. And even with a smaller investments in longer term, 10 to 15 years, you can at least expect thrice as much money flowing back to the state as it was invested in the first place. Details of the calculations. We also looked at the funding rates, which we expect how they will be affected. So all of this is in the paper, which I highly recommend. So now what not to do. So I said, for me, the most important part conducting a study was to securing that this model is really correctly implemented. And there are several points I really want to stress again, what could possibly go wrong, and why this is so important to implement this in a proper way so that it works and that really attracts private money. So the independent management is probably the highest priority, right? It has to be recruited from internationally, and has to be recruited, and also has to include a competitive remuneration so that really you can get best people. As I said, we don't want an Austria-only solution. We know that a lot of money will be invested in Austria, which is fine, but we certainly don't want to have this a highly restrictive corset which restricts the performance of the fund. We don't want a bureaucratic setup. So one of the prominent results from the economic literature on performance of public funds is the fact that they are really, well, annoying in a sense, because they are not working with milestones often, but they're working with a lot of bureaucracy. They're working with a lot of political pressure. So we really don't want that, because this will not make it a successful model. Regarding a short and long term, so a large part of the study was dedicated to the remuneration of the management, but from one particular perspective, the perspective of how to remunerate long-term success and keep it secure from political pressure for short-term success, right? So we know that in particular in industrial application, deep clean tech, those things, they take time, and they will not give you high rates of returns within 2 to 3 years. They will be essential and they will work in 10 to 15 years, but obviously the political pressure could be for short-term success. So we need to secure that the model is implemented in such a way that there is incentive for long-term commitments and long-term success and not short-term political, lighthouse projects. And what we don't want is including other asset classes. So it's important to keep it in a way which is constructed as a fund of funds investing in other funds, but certainly don't want to have other asset classes involved as investments, which might be tempting for the politicians for short-term success, but that's not something we want from this model. We need to have a very clear structure with a clear investment focus here. Last things last, what we also did is looked at what needs to happen in order to strengthen the Austrian VC scene even more. So the point being is like the fund of funds is a great initiative, but there are another steps which we need to take. The fund of funds will work if implemented properly, but it will work better if it's aligned with other policy steps which can be taken in order to strengthen the scene. So one of the things is the prudent person rule. So as I'm saying, I'm not a lawyer, but we had worked with lawyers who said, well, essentially there is not that much from the regulatory perspective which would, for instance, prohibit pension funds to investment in the fund. However, there's still a lot of risk aversion. So what we propose is that while it's in the law, it's quite clear that it's just a prudent person principle, it might not be clear in practice what that means. So in order to maybe make it a little bit more risk-loving from the side of the investors, we could clarify by law what this means, what is allowed, what are the assets categories you can actually safely invest in to have it a little bit less risk-averse. What we also did is looked at some other tax models which exist in other countries, which make VC investments more attractive. And obviously, for instance, some capital gains exceptions in some countries provide them. Luxembourg, the Czech Republic, for instance, after a certain period of holding of minority stakes, you can get your profits completely tax-free, which is a nice way to have more funds sitting in Austria and more investments in Austria. So that would be one thing. The other thing, which is still not fully resolved, is the question of taxing carried interest. So, as I'm not a lawyer, but as far as I know, this is really fairly unclear how to deal with carried interest in certain cases, and many other European countries have implemented steps to make it more clear from the tax perspective, Spain most recently, which really clarified how you tax it, what you tax, and under what circumstances. It gives you more security. For those who are in Austria, I guess most of you have followed the implementation of Flexco and the changes to the tax law, which have been made in particular for the case of stock options. So there has been an improvement of the situation. Yeah, that's two last sentences, in fact. And there has been a movement, but we think it's not enough. We think we need to reopen the model of the ESOPs and make it even more attractive to catch up with other countries. And then we discuss tons of other stuff. And the last thing is that the very, very important thing is to create a climate of investment, trust and reliability. I don't think talking about wealth taxes and all the other things in Austria helps, quite the opposite. So if you want to have investors in Austria, you really need to have a long-term perspective of reliability of the political tax and political structure. Thank you. Sorry.